What are the pros and cons of a put ratio spread? Have you ever wondered how traders manage risk while trying to profit from stock movements? One strategy that comes into play is the put ratio spread. This strategy involves buying one put option at a higher strike price and selling two or more put options at a lower strike price, all with the same expiration date. This creates an imbalance in the number of puts bought and sold, which is where the term ratio comes from. Let's break down the pros and cons of this approach. First, let's talk about the advantages. One major benefit is income generation. By selling more puts than you buy, you can collect premium income. This income can offset the cost of the long put and might even result in a net credit when you enter the trade. Another pro is that your maximum loss is limited if the underlying stock price rises above the long put strike price. In this case, all options would expire worthless, and your loss would be limited to the initial debit you paid. If you entered the trade for a net credit, you could even keep that credit. The strategy also has profit potential when the stock price is near the short put strike at expiration. Here, the short puts expire worthless, and the long put retains its maximum intrinsic value. Additionally, the long put offers some protection if the stock price rises, providing defined risk on the upside. Flexibility is another advantage. You can adjust the put ratio spread by changing the number of short puts or the strike prices to tailor your risk and reward according to your market outlook. Now let's consider the downsides. One significant risk is the unlimited downside if the stock price falls below the short puts. Since you sold more puts than you bought, losses can be substantial and theoretically unlimited until the stock price hits zero. The risk profile of this strategy can be complex. The payoff diagram is nonlinear, with profits peaking near the short strike and losses increasing sharply below it. This makes risk management a bit more challenging. Another con is that selling more puts than you buy may require significant margin. This can increase your capital requirements, which is something to keep in mind. Maximum profit occurs only if the stock price is near the short strike at expiration. If the stock moves sharply higher or lower, your profits may diminish or losses may occur. Lastly, there is potential assignment risk. The short puts can be assigned early, especially if they are in the money before expiration. This can complicate your position and lead to unexpected outcomes. In practical terms, the put ratio spread is a strategy that seeks to capitalize on moderate declines or stable prices near the short strike. It combines income from selling puts with downside protection from the long put but carries significant risk if the stock price falls sharply below the short puts. Traders need to carefully consider their risk tolerance, margin capacity, and market outlook before using this strategy.